We have a big gap down. We're getting near last week's low. I'll put up the daily chart. Daily chart, we have a double top, and we'll probably get some kind of a bounce today or tomorrow and an attempt at a double bottom. And this might end up becoming a triangle, so maybe bounce for a few days, and then we'll have a triangle. The bulls will hope it's a double bottom and it's sort of a trend up, a higher low major trend reversal. And the bears hope it's a double top. And if we get a lower high, they hope it's a double top pullback or a triangle, and we get another leg down. I do think we're going to bounce around last week's low. We may go a little bit below it, maybe a little bit above it. We could get a bull trend from the open. But when we were selling off so sharply down here, I said we probably would be sideways for about a month. And this is about a month. And it looks like we're probably going to bounce here and continue the sideways and maybe form a triangle. Weekly chart, we have a micro double top, up, down, up, and the lowest point in between is the low from 2 weeks ago, which is just about the same as last week's low. And the bears want to break below the neckline and go down for a third leg down. I keep saying I want the third leg down, and then a reversal up from the third leg. We would have a better wedge. It would be a second attempt at a wedge. It would be a higher probability for the low for the remainder of the year. But if everybody wants that, it reduces the chance of it happening, because traders will be so afraid it might reverse up from a higher low, they'll start buying above this low. So sometimes you'll get very close to this low, but not below it, and then you get the reversal up. Monthly chart, we still have a long way to go. I do not think this is going to be a big bear month. We've had 3 legs down, 1 pullback, 2 pause, 3. We may go a little bit lower. I don't think we're going to go much lower. Even with the sell-off today, I still think there's only a 30% chance we get all the way down to the pre-pandemic high, around 3,300. Bulls want a bull trend from the open, but they got to get this bar to close near the high. If it closes on the high, it's a reasonable buy. That's not what I want. Okay, we're right below the open of the month, the green line. And that means right now, on the monthly chart, we have a bear body. And we're right above last week's low. The bears could call last week a low one sell signal, where we bounced for a few weeks, but it's a bull bar, and we had 2 bull bars. So there probably are buyers below last week's low if we get there. Globex low, 90% of the time, we're going to break out of the Globex range. But if we rally from above the Globex low and get up here, then today will probably be one of those days that does not break out of the Globex range. A couple of days a month, we do not break out of the Globex range. And those days usually have a big Globex range, like today, 120 points. A couple of days a month, we break both out of the top and the bottom of the Globex range. And those tend to have small Globex ranges, like yesterday. Right now, we're probably breaking below the Globex range in the first hour. But, as I said, if one is a bull bar closing near its high, it's a reasonable buy for a possible bull trend from the open. The bigger the bar, okay. The bigger the bar, more traders will buy. Can you sell down here betting on a bear trend from the open? No. Why do I say that? We're very far below the moving average. And yes, there are magnets below last week's low, the Globex low, but we're very far below the moving average. And I would like to see consecutive bear bars, like yesterday, 3 and 4 consecutive bear bars before I'm willing to sell far below the average price. I forgot to turn on the numbering. Okay. So right now the market's deciding, is this going to be the low of the day? Is this going to be the start of a bull trend? And the more it closes on its high, the more likely traders will buy, and the more likely we will get a rally on the open. Bulls are trying hard to get it to close on the high of the bar. If it has a conspicuous tail, 3 or 4 points, see, that's, for me, just too big of a tail to buy on a stop above 1. And that's why 2 is doing what it's doing. There were a whole bunch of traders buying during 1, hoping 1 would close on the high and that 2 would trade higher. But because 1 did not close on the high, a lot of the bulls who bought during 1 are selling, and that's what's causing 2 to drop down like that. Now, if we go up, we'll have a micro double bottom. We gapped down, we rallied, we sold off, and we're rallying again. So the bulls are trying to get a micro double bottom. The big problem they have is the Globex low. On the 15-minute chart, we're just above the Globex low, and for 4 bars we've tried to reverse, and we have been unable. So we're still under the influence of that magnetic pull, and the odds are we're going to go below the Globex low. The bulls are hoping to get some bull bars and get back up to the middle of the Globex range. If we get back to the middle of it, then we probably will not break out of the Globex range today. Okay, breaking above 1, but the tail on the top of 1 will reduce the number of bulls willing to buy. And can you sell below 2? No, because you'll have 2 bars on the day, one of them a big bull bar, far below the average price. If you're going to be selling far below average, you want bars that are far below average. And if 50% of the bars are big bull bars, that's not far above average bearishness. So 80% of the time, you're going to have a trading range open of some kind. And I think it's a little bit more common when you have a big gap. The bears do not want to sell too far down, and we gap down because of some bearish event, and the bulls are hesitant to buy. So the market usually has to get closer to the average price over the first hour or 2, and then it decides on the direction of the first swing. Now, for the bulls, 1 was not a great buy. They're trying to get 2 to close on its high. That would increase the number of traders willing to buy. If 2 also has a fairly conspicuous tail, a lot of the bulls will continue to wait. The bars are big. Everything is big here. If you're buying above 2, you're risking at least 20 points, and that's bigger than what you normally would risk, so you trade small. And I often say you should have 2 position sizes, your normal size, and then a small size. And whenever you look at the chart and you say, I don't want to take it because my stop's too far away, then you trade the small size. And the small size should be about 20% of the big size. Now, who's going to sell below 2? Nobody. What about the Globex low being a magnet below? It is a magnet below, and we'll probably go below the Globex low. But we're far below the average price, and we have a big bull bar on 1. So 2 would not be enough to make this far above average bearishness. Bull is trying hard to get 2 to close on its high. If 2 closes on its high, then it would be a good bull bar on the 10-minute chart. And if 3 closes on the high, then we have a 15-minute good-looking buy signal bar in an oval market. And that could probably would lead to some kind of a bounce. If you buy above 2, your stop is below 1, not below 2. When you have big bars like this, a lot of traders don't want to risk that much. So some of them, instead of buying small, will place a limit order to buy about a 50% pullback. This is a really good bar for the bulls. But the risk is really big. And now the risk is 30 points. So if 2 closes within a couple points of the high of the bar, it's a buy. So that's a buy the close, buy above 2. Usually it's better to buy with a stop above. But the problem you have is your stop is 30 points away. So if you took that buy, you have to trade very small. And a lot of traders do not want to risk that much. So instead of buying at the high, they'll look to buy with a limit order at a 50% pullback. The open of the month is a very important price. So it's possible that we'll rally a little bit more until the open of the month is a 50% pullback. So it's possible we'll rally up to near yesterday's low and then try to pull back. Can you short below 2? Possible bear trend from the open, a bull trap like yesterday. Yesterday we had two big bull bars on the open, and then we had a bear bar closing near its low. A reasonable sell, but that was at the 60-minute moving average. And it was also toward the top of the trading range from yesterday. Here, we're far down, and therefore, I would not sell below 3. Suppose 3 is a big bear bar closing near its low. It might go down 5 or 10 points, but if you do take a sell, I'd be very quick to get out. I'd rather look to buy a pullback to around the open of the month or a 50% pullback. I'll make this exact. So that's 50% right there. Can you buy the 50% pullback? My big concern is the Globex low. I still, at this moment, it's still likely we're going below the Globex low, which means it's still likely we're going below the low of 1. So I'm a little bit hesitant to buy the 50% pullback. Do I think you can do it? I think a lot of traders are not going to sell below 3 for the same reason a lot of traders did not buy above 2. If they sell below 3, the risk is big, and they don't want to risk too much. So I think there'll be buyers on the close of 3. I think there'll be buyers at the 50% pullback. And as for shorting, hoping it's like yesterday, I'm not going to do it. Yesterday we had 2 big bull bars and then a bear bar closing near its low. Today, 2 big bull bars, a bear bar closing near its low. That was the high of the day. I don't think this is going to be the high of the day. That's too much buying, and we're too low down. Plus, on the daily chart, we had 6 consecutive bull bars. I said we probably would get a pullback for a day or 2. This is the 3rd day of the pullback. Okay, that triggers the low 1 sell, but I think it's not an ideal sell. You can see it bouncing at 50%. There is an unknown number of buy limit orders there. Now, what happens if we get consecutive bear bars with decent bodies and closing near their lows? It's sell to close, but we're still far below the moving average, and we have exceptionally good bull bars 1 and 2. So I still would not sell below 3 or below 4. I would just let it go and then see what happens around the Globex low and the low of 1. You can see a lot of 50% bulls bought, and it looks like the bears are so scalped out. They took 5 points, so they're risking almost 15 points, and they are happy to take 5. So that's not very bearish. Buying above 4 is similar to buying above 2 and selling below 3. Big bars, big risk, and increased chance of limit order traders betting on a reversal. We went above 2, reversed down. Went below 3, reversed up. Now, will the bulls who bought the 50% pullback, will they scalp for 10 points? They got their 10 points, right? And that's part of the reason why 4 is stalling. You got the bulls who bought the 50% pullback, concerned that 3 might be the start of a trading range. So some of those bulls are taking profits or partial profits at 10 points. Can you buy above 3? Well, think of it this way. If the market's always in long on 2, and if you get out below 3 and you're trading always in, you have to buy again. And you either buy above a bull bar closing near its high, or you buy above the most recent high, 3. So theoretically, it's a stop order buy above 3. But this is dangerous trading. Now, the bulls who bought 2, the close of 2 or above 2, what are they thinking when they see 3? They're thinking, oh no, that's terrible. It's really disappointing. So what do some of those bulls do? They might buy more, 10 points lower, 20 points lower, and then hope it gets back to the 2 close. And then what will they do? Some of them will sell out of their longs, saying, wow, I'm so relieved to be able to get out without a loss. So you have buy the closed bulls, 2, disappointed 3, and an unknown number of them will exit here on 4 now that we're back to their entry price. Bulls want a gap They want 4, close above 3, and then a measured move up, which would get us to yesterday's close. And the bears want a low 2. Remember what I said on the open? I said 80% chance we're going to have some kind of a trading range open. If we reverse below 5, that would further increase the chances that we're going to have a trading range open. So here we have a really good bull bar 2, and they sold it. And here we have another really good bull bar 4, and we don't know if they're going to buy it aggressively. I said selling below 3 was not a high probability bet. If 5 looks like 3, you'll get a lot more bears willing to sell, and you'll have bulls selling out of longs. The bulls who did not sell out of longs on 4, if we get a second reversal down, they'll probably sell out below 5. So you'll get more traders willing to short below 5. For stops, right now the stop is below 4 or below 1, which is far below. But if 5 is a bear bar closing below its midpoint, if I were long, I'm not. I bought down here and scalped out and back to flat. But if I were still long, I would exit below a bear bar closing below its midpoint. Bulls are hoping 4 is a measuring gap, a gap between the close of 4 and the high of 3. And they'll try to get 5 to close at or above the high of 3. They'll try to keep the body gap open. Right now, if the gap has closed, the low of 5 is below the high of 3, but the bar has not yet closed, and there still might be a gap between the bodies. And if there's a gap between the bodies, that's still good for the bulls, and it still could lead to a measured move up. Can the bulls prevent a bear body? Can they get 5 to close above 4? Can 5 become a big bull bar? The more of that they get, the more likely we're going up to yesterday's close measured move up. Can the bears get a bear body? Can they get a bear body closing below the body of 3, the open of 3? Can they get a big bear bar closing on its low? The more of that they get, the more likely we're going to get down to the Globex low. This is trading range behavior. For a trading range open, the minimum that I want to see is after the first bar, 2 reversals. And we have that. We reversed down below 3, and then we reversed up on 4. So for me, this is a trading range open. It's still a possible bull trend from the open and the start of a big bull trend day. But right now, it's more likely a trading range open, and the market is looking for the top of the range. It could be bar 5 if 5 closes near its low, or we could get one more leg up through a little wedge. So 1, pullback, 2, pullback, and then 3. The more 5 closes on its low, the more it's a big bar, the more bears will sell and the more bulls will get out. The less clearly bearish it is, the more bulls will buy below. But general rule, a bear bar closing below its midpoint, I think it's better to get out below 5. Big enough tail, I don't want to sell. I suspect we're going to get one more leg up. But sell out of longs, yes. Sell into shorts, I would not do it. Who are the sellers on 6? A lot of it, this is fairly mixed. A lot of it is disappointed bulls from the close of 2 exiting. And some of it is bears selling. And the reason why I think fewer bears would sell is the tail on the bottom of 5. A lot of bears don't want the hesitation, especially when we have huge bull bars like 2 and 4. 1 and 2 is a strong enough pair of bars to get 3 legs up. And the tail on the bottom of 5 is not strongly bearish. So we still might get a 3rd leg up before we get a reversal down. Do I think we're going to get a reversal down? Yeah, I think 3 and 5 are problems for the bulls. So I think we're probably going to test down. I don't know that we'll get to the Globex low. We may have seen the low today. This is bar 6. By the close of bar 7, 50% chance we've seen the high or low of the day. The rally is big enough so that there's probably a 50% chance now that one will remain the low of the day. Bulls trying to get a high one and then a third leg up. They hope the third leg up will break out above 5 and lead to a measured move up. And the bears hope that there'll be sellers above 5 and a wedge reversal, 2, 4, and maybe 7 or 8. The more 6 closes on its low, the more bears will sell below 6, and the remaining bulls will probably give up. And the more it has a big tail below, the fewer bears will short, and bulls will be willing to buy. They're not going to buy above 6 if it's a bear bar, but if it's a bull bar closing near its high, they'll take a chance. I'm not going to buy above 6 because I think it's trading range open, and if we go up above 5, I think we'll probably get a wedge and a reversal. And what about selling below 6? Well, if it closes near its low, within maybe a point of its low, especially if it becomes bigger, that would be a reasonable swing sell, betting that we'll get down to the Globex low. 6 is a multiple of 3. It corresponds to a 15-minute close. And on the Globex chart, the bears are hoping for a low 2 sell signal bar, 15-minute chart, but they need the bar to close near its low. That's 20 points down, and we only have a minute left to the bar, so that's not going to happen. The bears are not going to get a good sell signal bar on the 15-minute chart. It looks like we're going to go higher, one more new high. Also, 4 is a big enough bull surprise to expect at least a small second leg sideways to up. Bulls are trying hard to get a good buy signal bar, but as I said, I think if we do go above 5, there'll be sellers and we'll get a wedge. There's often a report at 7 o'clock, so 6 is often a difficult signal bar because it often changes its appearance in the final seconds, and the high may be higher or the low might be lower, and you have to make a really quick decision on order placement. So you can see the bulls are trying to get a bull bar closing near its high for a better high one buy. They're hoping this is a small pullback bull trend, but more likely it's the top of a trading range open, and we'll get a swing down maybe after one more new high. Can the bulls get a bull bar closing near its high? If they do, okay, that's not good enough. They have a bull bar, but it's not closing near its high. So you got disappointed bulls selling the market. As soon as they saw 6 was not a big bull bar, they sold because they don't want to buy above 6 unless it's going to be a big bull bar. And when they saw 6 having only a bull doji, the bulls said, I don't want to buy above 6. There'll be sellers up there. So the bulls sold. And the bears knew that, and the bears sold. And that's why 7 looks like this. Everybody wanted to see, was 6 going to be a good buy signal bar? If it was, the bears would not sell above 6. They would sell above 5. And the bulls would buy above 6. Can you sell the close of 7, betting that we'll get down to the Globex low? What did I say on the open? I said it's probably a trading range open. And trading range open, it implies some things. First of all, it implies reversals, and that's what we're getting. We were down on 2, up on 2, down on 3, up on 4, down on 5, down on 6, up on 6, down on 7. So reversals. And if you have reversals, it's bad for stop entry trading. Buying above 2, buying above 4, right? It's much more limit order trading, and traders look for quick profits. The bears have sold below 7, below 5, they could get their 10 points. So what are they doing? They're buying back their shorts, 10 points below 5. And that's what's causing this bounce on 7. Limit order trading, trading range open. Traders get quick profits, they take the profits, and then they look for the next trade. So bears are buying back shorts, 10 points below 5. For the bulls, a higher low double bottom 4. Is it a small pullback bull trend? It looks like it, but it's really not. The pullbacks are big and the bars are big. So it's probably not going to continue up all day in a small pullback bull trend. More likely, we're going to have a trading range open. Bulls keep buying, right? Bears bought back their shorts, 10 points below 5. The bulls knew they would do it, and the bulls placed limit orders to buy 10 points below 5. They're trying to close the gap, and the bears did not have a good sell signal bar. They did not have a good entry bar, and they tried to get a big bear bar 7, and they scalped out. The bears bought back their shorts. So the bulls are still hoping we can go higher. This is very difficult trading. The high of 6, why is it like that? You got by the close bulls 4. They went on, they're disappointed 5. A lot of them decided, I'll place a limit order to get out maybe with a 1 or 2 point loss. And that's what caused the high of 6. The bears knew the bulls were disappointed 5, and the bears sold as well 1 or 2 points below the high of 4 or the close of 4. So here we have what looks like a small pullback bull trend, and we have a high 1, a pullback from a new high, but 2 decent bear bars, a bad buy signal bar 6, and then 7. It's a high 1, but it's a huge bar, 20 point tall, 18 points tall. Not a lot of bulls are going to want to buy above 7. So stop order traders are making some money, but not a lot. They sold below 3, made 5 points. Sold below 5, they made 10 points. Bought above 1, they made 10 points. But bought above 2, bought above 3, they lost. So they bought above 2, bought above 4, they lost. Some bulls are still long, stop below 1, but I would not do that. I would get out below 3 or below 5. Bouncing around fast, big moves, very big risk. So anybody trading this should trade very, very small. It's a limit order market, so buyers will buy high if they're using wide stops and scaling in. So here we have a double bottom, 4 and 7, but a bear bar 7 at the top of right now a 6 bar tight trading range, 7 bar tight trading range. So probably sellers above 7, sellers above 5. And for the bears, there were buyers on the 6 low and 7 low. So limit order trading. Traders are buying below, selling above. Not good for stop order traders. Theoretically, the stop order bulls above 4 are still long, stop below 4. So some of them are buying more, 5 or 10 points below the close of 4. But trading range open, and now we have 7 sideways bars. Do you really want to be buying about at the top or selling at the bottom? It's better to just wait. Is it still on the buy above 4? It looks like the bulls exited around the close of 4 on 6 and 7. So I don't think it's still on the buy above 4. It's still on the sell below 5, but weak entry bar, weak signal bar 5, weak entry bar 6, weak follow through 7. So it's really difficult to do anything here with stops. It's difficult to trade with stops here. What happens if we do break below 1? Will this become a huge bear trend day? Nope. I say that because of the daily chart. We're in the middle, bottom half of a month-long trading range. We have a double top, pretty good reversal up, pretty good reversal up. 4 bull bars here, 6 bull bars here. There probably are buyers around the June low. We may go a little bit below the June, this is the June low. This is the June 30th low. There are probably buyers around that low. We're around it now. The bulls want a higher low and a triangle, but if we go below it and reverse up, then it becomes a big high 2 legs down, 1 pullback 2. But either way, there'll be buyers above it trying to get a double bottom or a triangle, and buyers below it trying to form a high 2 with the June 30th low. So unclear. Could be this, could be that. Unclear. Traders are looking for reversals, which is what they've been getting over the past month. Still on the sell below 5. It did not go above 6, so theoretically the bears are still short. But you can see 6 and 7, a lot of the bears scalped out. Now, at some point, if the bulls have not gotten out, they have to give up. And if 8 is a bear bar closing near its low, that could be enough to make the bulls give up, and it could create a second consecutive big bear bar, get us below the low of the day and down to the Globex low. So 8 is an important bar. The more it closes on its low, if it closes at or below the low of 7, the more bulls will sell out of longs and give up and not wait for a stop to get hit, and the more bears will short. Everything is big, so if you do anything, you have to trade small. Trading range behavior. 8 could not close at or below 7. So you'll have fewer bears willing to short. But bulls, as I said, I would have gotten out below 5. Some bulls are still long, hoping for a higher low or a double bottom 4. But more and more bulls will give up below a bear bar, a big bear bar, like 8. Bulls hoping for a higher low and a reversal, 9. We're getting late in the hour, so traders are starting to think about the 60-minute bar. Will it close on its high? Will it close on its low? And if it's not going to close on either, then traders start to think about the middle of the bar, and that's the middle of the hour. So right now, that could be a magnet at the end of the hour. Well, will 9 attract a lot of buyers? Higher low, bulls channel, double bottom, higher low, 4, 2 big bear bars. So not a lot of bulls willing to buy above 9. And for the bears, it's an inside bar and a low 1, but it's a bull bar. So not a lot of bears willing to sell below 9. So probably buyers not far below 9 or 8 or 4, and probably sellers not far above 9. So limit order market, the middle of the trading range open. It's still on the sell below 5. You get out above 9. You might get out 5 points above 9, 10 points above 9. You might get out above 5. I think it's better to be flat. When you look at it, you see a lot of reversals. Is it going up? Is it going down? Nobody knows. 50-50 chance it'll go up, maybe form a double top with 5. 50-50 chance it'll go down, maybe form a double bottom with 4 or with 1. So, and 50-50 chance, if it starts to go down, it'll reverse up. If it starts to go up, it'll reverse down. So this is bad math. We're still on the sell below 5. So can you sell at the market and exit above 9? The math is probably okay. You're looking for a move down to below the Globex low, so you're trying to make 20 or 30 points, and you're risking 15 points. You can see they bought the 9 low, at least so far they did. Are we always in long or short? I think we're probably always in short. You can argue either way. You can argue we're still on the buy above 2. We still never fell below 1. You can argue we're still on the short below 5. But I think it's pretty neutral right now. The bulls want a higher low major trend reversal and the start of a bull trend. And the bears are hoping 5 will remain the high of the day. Most traders are better off waiting. Can you buy above 9? Can you buy above 10? Right now we have a 6-bar bear micro channel, and we're just below the moving average. So not a very good buy above 9 or 10. And for the bears, it's a low 1, but the bottom half of the trading range open plus a bull bar, so not a very good sell. If I had to be long or short, I would choose what the most recent signal was, and that's the short below 5. So if I had to be long or short, I'd be short. At the moment, I'm flat. The bulls tried to get a gap above 3, failed. The bears will try to get a gap below 8 or 4, hoping for a measured move down to last week's low, which is below the Globex low. So the close of 10 is important. Will it close at or below the low of 8? Then we might get a possible measured move down. So a measured move down from the high of 5 to the low of 8 takes us to there, which is almost exactly at the Globex low. Globex low is at 37.52, and this measured move is 37.53. Always in short, not strongly bearish. Bulls are hoping for a micro wedge, 7, 8, 10, double bottom 4, but they're allowing too many bars in the micro channel. We're below the moving average. We're always in short. We're on a sell signal, and we now have a 6-bar bear micro channel. So not many bulls are going to buy above 10. Bear is trying to get a gap and a measured move down. Does it sell to close 10 or sell below 10? It is. We're always in short, and it looks like we're going down, but the bars are big, and it also looks like a trading range open, so we're probably not going to go really far down. Selling below 10 is like buying above 2 and buying above 4. Trading range behavior, there is a 50-50 chance there'll be more buyers than sellers. The bears want to keep the body gap open. Right now the gap, there's an actual gap, close of 10, low of 8. Bulls want to get above the 8 low to close the actual gap, but the bears will try to keep the body of 11 from overlapping the body of 9 so that we would still have a body gap and a possible measured move. Getting late in the hour, the midpoint of the hour is here, and that might be the magnet. This is a higher low double bottom 1, a lower low double bottom 4, a little wedge 7, 8, and 11, and bulls trying to get a good bull bar. The more 11 closes on its high, the more bulls will buy, betting on a higher low major trend reversal, and the more bears will give up. I would get out of shorts above a bull bar closing above its midpoint, and for the bulls, if 11 closes near its high, it's a reasonable candidate for the low of the day and a reasonable buy. For the bulls, it's basically a higher low double bottom 1, and the second leg down is a wedge, 7, 8, and 11. It doesn't look like a wedge, but it's a wedge. Maybe let me check a smaller time frame chart. So look at it. It could be a wedge here, 1, 2, 3, or 1, 2, 3. Different computers see it differently. If 11 is a bull bar, but only a bull doji, or it has a big tail on top, I would not buy it. To buy it, the bulls need 11 to close within a point or so of the high of the bar. And it's a 7-bar bear microchannel. That lowers the probability, but it's a trading range open, a higher low double bottom, so it's a double bottom with the second leg down being a parabolic wedge. That combination makes it at least a 40% chance of a swing up. Traders who do not want to buy the first reversal up, they can wait for a second bar. Does this have to convert into a trend now? No, trading range opens often last a couple hours. Yesterday it lasted half the day. We had a trading range open, and yesterday was a big triangle. We tried to break out of the top, we failed, and then we sold off. So first half of the day, a triangle, and then a breakout. Sell the closed bears. 10 are concerned that they could not even make 5 points. So some of them are buying back shorts on 11. Okay, that's enough to increase the chances of the market going down. We have a bear breakout 10, so we have consecutive bear bars, 10, 11. one of them big and closing near its low. So that's a sell to close market, and it increases the chances for going down. You can get out of shorts 5 points above 11, maybe a tick above 10, but it's not a good enough buy for me. Parabolic wedge, a double bottom, second leg down, a wedge. That's a good pattern, but you want a good buy signal bar. Maybe 12 will be a good buy signal bar, but right now it's not good enough for me to buy above 11. If you buy above 12, really not ideal. Remember I said 10 gap below 8, the 10 close 8 low, and we're closing the gap. And not only are we closing the gap below 8, we might be closing the body gap, the gap between the bodies, on a close of 10 and the body of 8 or 9. And that is a problem for the bears. It looks like we're oscillating around the open of the month. So will the monthly bar be a bear bar or a bull bar? I think it's too early to pay much attention to the open of the month, but today is obviously paying attention to it. Most of the bars today have touched the open of the month. I'm going to get rid of this measured move, but I'm going to leave in the midpoint of the hour. The bears want the hour to close below the midpoint, even if it has a bull body, and the bulls want the hour to close above the midpoint. That will increase the number of bulls willing to buy above 12. Bears, okay to get out 5 points above 11. You can always sell again below a bear bar, or you can sell again below the most recent low, 11. It's a trading range open. I don't want to sell low, even though it's sell to close 10, 11, and I did not want to buy high, above 2, above 4. And now it's the opposite problem. Do you want to sell low? Is it bearish enough to sell low? It's more limit order trading. Probably sellers 11 high, 5 points higher, 10 points higher. I want to say one other thing about the big bars. If you bought above 2 and exited below 3, if you bought above 4 and exited below 5, and if you traded normal size, you'd have a 15 or 20 point loss in the first hour. And how many days every month do you make 20 or more points? Probably not many. And therefore, if you took those buys, you're probably not going to make back your loss. So right in the first hour, you just ruined your day. You'll feel desperate all day, hoping you make back your loss. And then by the middle of the day, you won't think about making back your loss. You'll hope you make back half of your loss. So you don't want to get big losses early in the day. Bars are bigger, you trade really small. Later in the day, the bars will get smaller, and the profit per trade will get less. So if you have a big loss early in the day, very difficult to make it back later in the day when the bars get smaller. So for the bulls, it's a buy, but not a very good one. The hour closed just above the midpoint. Good for the bulls. But we have a 7-bar bear microchannel, a bad buy signal bar, 11. So for me, it's not worth buying above 13, above 12. What happens if it goes above 12? Well, bad buy signal bar, 11 high. So you'll have bears selling 5 points, 10 points, 15 points above 11, betting that we're going to dip at least 1 tick below the 11 high. So that's what's going on here. Not a lot of buyers buying, limit order bears selling, looking for a 5-point scalp. They sell 5 points above the 11 high, betting it's a bad buy, and not many buyers far above. And then it comes back 1 tick below the 11 high. That allows them to get out break even on their first sell and with a 5-point profit on their second sell. Lots and lots of reversals. Every bar or two is reversing. Very bad for stop entry traders. So better to wait. Really important. I sometimes talk about this, that if you've been trading for a few months, you're taking a lot of good trades, but you're still losing money. And the reason you're losing money is you're taking a lot of bad trades. And the key one of the most important keys to becoming consistently profitable is getting rid of the bad trades, or a lot of them. And so don't buy above 1, don't buy above 4, don't sell below 3, and don't lose all that money. Bulls trying to get consecutive big bull bars closing on their highs, but they really need a break above the moving average. A lot of really big bull bars today, 1, 2, 4, 12, 13. That significantly reduces the chances of today being a big bear day. The bulls just keep coming back, so relentless, aggressive buying that reduces the chances today will be a big bear day, even if we do go below the Globex low. So today will probably be mostly a trading range day. If it's going to be a trend right now, I think up is more likely than down. Remember, we had 6 consecutive bull bars on the daily chart, and I said we might pull back for a day or two. This is 3, and the bulls are going to try to get a higher low double bottom and a rally, and then maybe a triangle, or maybe this could be the low for the year. At the moment, I still think we're going to get one more new low, slightly more likely we'll get one more new low. But if we do, I think there'll be buyers below. Really good bar for the bulls. We're breaking above the high of the day, breaking above the moving average. Bulls will try to close the gap below yesterday's low and try to get a measured move up to yesterday's close. Can you sell the close and bet that we'll get a double top 5? Bears will do that, but if 13 closes near its high, we'll have consecutive very big bull bars closing near their highs. A bull surprise will probably going higher, so I would not do it. But you can see some bears are doing it. They're selling at the moving average. They're selling at and just below the 5 high. The bigger the tail, 13, the fewer bulls will buy the close, and the fewer bulls will buy above 13 and above 5. Bulls trying hard to get it to be as bullish as possible. That tail is enough to reduce the number of bulls willing to buy above 5, the high of the day. It's the neckline of the double bottom 111. You can take the buy and take a chance on the swing up, or you can wait. You can wait to see if 14 closes above 5. You can wait to see if we get consecutive closes above the moving average. Right now, I think we're always in long, but traders will be more confident of that if we get a big bull bar closing far above the moving average and far above 5. You can see this hesitation. Bears taking a chance. They'll sell the moving average. They'll sell the 5 high, betting on a failed breakout, and a big low 2 legs up, 5 and 14. So are there going to be more bulls buying the breakout or more bears selling the breakout? The bigger 14 is, the more it closes on its high. The further above the moving average it closes, the more evidence that the bulls are in control and that we're going up for the measured move. If 14 looks like 5, the bulls will exit and bears will short. What's it probably going to do? Something unclear. So a bear bar that's not quite big enough to get many sellers, a bull bar that's not quite big enough to get a lot of buyers. So it's probably going to do something unclear, because it's still a trading range open, and we still do not yet have a clear breakout. The minimum the bulls want is a bull bar or no bear bar. They would like to get a close above the moving average, a close above 3, a close above 5. And the bears want anything other than a close above the moving average and a close above 5. What happens if 14 suddenly closes on the high of the bar? You'll get more bulls willing to buy. But this hesitation, you see it close right at the moving average. Bull surprise 12, 13. I think we're going to go higher. We might pull back first. Is anybody going to sell the double top, sell below 14? Probably not. So there'll be buyers below 14. But are we going to get the breakout? Don't know yet. We might have to pull back. I think we're going to close the gap below yesterday's low, but we might have to go sideways or even a little bit down first. And what about the Globex low? Can we still get there? It's still within reach, but this is a problem for the bears. Just too many big bull bars. You know, that makes today likely to be either a bull trend day or a trading range day. And then you look at the daily chart. We had 6 bull bars. That's a lot of buying. So we're probably going to have a bull bar today after 2 bear bars. So it's a question of, is today going to be a small bull bar on the daily chart or a big bull bar on the daily chart? Can you sell below 14, double top 5? No. Suppose 15 is a bear bar. Can you sell below 15? It depends. If it's a big bear bar closing near its low, you can take a chance. But 12, 13, a pair of really big bull bars closing on their highs, and a reversal up from a double bottom, there probably will be buyers below 14 and not far below 15. So right now it's buy the market, buy the close, but stop below 11, and you're risking 30 points, so you have to trade very small. So really not very good for stop entry traders. Closing the gap, bulls want the measure to move up. Back to near the middle of the Globex range. Is there any reason to sell with a limit order here? No. Any reason to sell with a stop order below 15? If it looks like 3, then bears will sell, bulls will give up. But more likely, we're going to go higher. 6 bull bars on the daily chart, and we'll pull back, a deep pullback to a higher low, and the bottom of a month-long trading range. Traders are buying at the market. They can get out 5 points below 15, a tick below 15, but right now, today's probably going to be a bull trend day. And what kind of a bull trend day? Will it be a small pullback bull trend day? When you have these big bars, it's probably not going to be a small pullback bull trend day. It could be a bull channel. We could get a deep pullback to a higher low, or it could be a trending trading range day where we have a trading range, a breakout, and then another trading range or low, or it could be a trending trading range day where we have a trading range, a breakout, and then another trading range. Bears want a big low 2-5, but a good enough bull surprise. I think bulls will buy the first reversal down. Bears want to get back below the 5 high, the breakout point. But even if they do, today will then probably be a bull channel or a bull trending trading range day. Bulls reasonable to get out below a bear bar closing below its midpoint. Reasonable to get out 5 or 10 points below any bar, but I would wait for some kind of second reversal down before shorting. This is a big enough bull surprise, 12, 13, 14, 15, for me to consider it to be major. And a major bull surprise usually is going to lead to either a bull trend day or a trading range day, and not a bear trend day. So even if we sell off down here, we'll probably be in a trading range day. It's unlikely we're going to go far below 1. A low 2-5, but only a bear doji. Fail breakout yesterday's low. I would not short below 16. You can get out maybe 5 points below 16 out of longs, but there probably will be bulls buying 5 or 10 points below 16, and bulls buying around the 5 high and the moving average. At some point, bulls will take profits and we'll get a pullback. They'll try to get back below yesterday's low, and they probably, the bears will try to get it back below yesterday's low. And it should fall below yesterday's low. I don't know that we'll get down to the 5 high. We might. Not a good looking buy above 16, especially since we didn't have a pullback yet. So you don't have a lot of bulls who exited who are panicking to get back to long. So there's less incentive to buy above 16. Possible sort of a pullback here or soon. Bears are hoping it's a big low 2.5, a second leg trap. Failed breakout above yesterday's low. We have a micro double top. Up on 15, down on 16. Up on 17, down on 17. Okay for bulls to exit below a bear bar on 16. And for the bears to short. Sorry, I don't understand. That's my phone, my Google Pixel phone. Anyway, for the bears to short, I think it's really not a very good short. Okay for bulls to get out, and for the bears, it's a low probability bet. Maybe we'll close the gap above 5, but this is probably not going to fall much below the 5 high and the moving average. There probably will be buyers either at the 16 low, the 17 low, or 5 or 10 points below. So I think not a very good short. I would let it go and look to buy a pullback. And for the bulls, they're buying the close. They're trying to prevent the pullback. But that's a lot of points. So I suspect we'll get profit taking here or soon. 16, 17, that already is a little bit of profit taking. Can we get up to the Globex high? I don't think so. It's another 60 points above where we are. And there would have to be a huge day to do that. It would be over 100 points range. So if we're not going up to the Globex high and the high of yesterday, how far up will we go? The next two targets are yesterday's close, and we'll probably get there. And then the measured move will probably get there. We might get to the 60-minute moving average, but I do not think we're going to get to yesterday's high, and I do not think we'll get to the Globex high. So the high of the day will probably be above the current high and below that, and this is probably going to remain the low of the day. So buyers below around here, and sellers above around here and around here. I do not think we're going to make it all the way up to here without pulling back first. I think we're probably going to pull back within the next few bars, maybe to the 5 high area. And there'll be buyers there. Probably a minor reversal. The bears are hoping it's a second leg trap and the high of the day and the start of a trend down, but the probability is low. So anybody shorting below 17 has to be hoping that it's going to sell off the next hour or two. I would rather wait for more evidence. Bulls, reasonable to get out below 16 or 17, but there probably will be buyers below around the moving average. High 1, but tight trading range in tails. As I said, I think we're going up to yesterday's close, but we might pull back first. And for the bears, micro double top, micro triple top, it's a low probability short. You're hoping that instead of a bull trend, we're going to get a trading range day, that we'll get a deep pullback. And sometimes it happens, but I'm not willing to sell with a stop yet. I'd rather look to buy around the moving average and yesterday's high. So instead of selling, I'll wait to see if we get down here and reverse up again. Bull bar, they bought the 18 low. We might get some kind of a wedge if we get one more leg up. So 1, 2, and then 3 somewhere up here. And that could lead to an upper trading range. If the bulls get out below 17, if they're trading always in, they buy again above 18 or 19, but it's probably going to be a minor breakout. Maybe we'll get here or here, but there'll probably be sellers around here. Sellers, most of them will be bulls taking profits, maybe forming a big wedge, 1, 2, and then 3, and then entering a trading range. What happens if 19, I was going to say if it closes on its low, you'll get more bears willing to sell. A high 1 or a bear bar, just like we had a low 2, 18, and a bull bar, they bought below. Now we have a high 1 and a bear bar. Might be sellers above. I think going up to yesterday's close, and therefore it's probably better to not sell the 19 high and sell, if you're looking for limit order sells, sell around yesterday's close or that measured move. Bulls, reasonable to take profits in that area. Just entered the profit taking zone, yesterday's close, and there's the measured move. And then beyond that, the 60-minute moving average, we might get there. I think we're probably going to get some profit taking in the next few bars and then maybe a wedge, 5, 17. But if we do get the reversal, that'll probably lead to a trading range. Remember I said today would probably become a bull channel and trend all day, or it'll form an upper trading range. So a trading range here, breakout, and an upper range. I think trading range is most likely. We may go a little bit higher. Maybe we'll get all the way up here, but I do not think today's going to get. I don't think it's going to go much above the 60-minute moving average. I think we're going to start to enter a trading range soon. Can bears start to scale into shorts? 17 high, yesterday's close, measured move. I think most traders should not do that, but I think the computers will be doing that, betting on profit taking and a trading range. Bulls trying to get another breakout. They would like 20 to close on its high, but they'll be lucky to get it to close above the 17 high. Starting to enter a trading range, 16. Close below 17 high, so not as bullish as what we've had earlier. Starting to get trading range behavior. We should get to the measured move target. We might get all the way up to the 60-minute moving average, but I suspect we're going to pull back starting soon, next few bars. From a fundamental perspective, the CPI came out today with 9.1% inflation. Why would the market ever rally with 9.9% inflation? Because traders think, that's about as bad as it can get. And therefore, we may be at the peak in inflation, and inflation will probably start to go sideways to down, and therefore the stock market can go up. I think that's the fundamental argument. And the technical argument is the one that I've been saying. We've been in a trading range for a month. We had 6 consecutive bull bars. Unlikely to get a third bear bar, and the bulls will try to get a higher low and then a reversal up, but we may just go up for a day or two and pull back again and form a triangle. So technically, we're at the bottom of a trading range, and we had 6 bull bars. Today was unlikely to be a bear day, so that's the technical thing. And the fundamental thing is the one that I said. The inflation was so bad in today's report, we're probably near a peak, and therefore things can only get better, and bulls saw the sell-off as a buying opportunity. I said we might get a wedge, 5, 17, and no, possibly 21, low 2, 18. If we get a bear bar 21, I think you will start to get stop order bears selling. They probably need a wide stop because we could go up higher. This is probably going to become a trading range since 16, but we do not yet know if this is the top of the range or if the top of the range will be up here. So anybody selling below 21, I think it's better to use a wide stop. Bulls, I'd get out 5 points below a bull bar. I'd get out one tick below a bear bar if it has more than a 1 or 2 point body. And for the bears, they really want as good a bear bar as they can get. The more bearish it is, the more bears will sell, the more bulls will give up, and the more likely we'll dip back below yesterday's high and maybe get down to the breakout point, the 5 high. But more likely, this is going to be a fairly tight range. So when we finally do reverse, we're probably not going to go much below the moving average. Bulls trying to prevent a bear bar. They're trying to prevent a big bear bar. They're trying to prevent a big bear bar closing near its low. The more bearish the bar is, the more bulls will give up, and the more bears will sell, and the more likely we'll go down. For the bulls, a high 1, always in long, magnets above, but we're starting to form a trading range 6, and we have tails 20 and 21. It might get a wedge 17, 20. So I would not buy above 21. Might be limit order bears 20 high, betting on the wedge. Stop order bears 21, not good enough to sell. By the way, yesterday I bought the euro. I know I have, maybe it's over here. Yesterday's low was almost exactly at par, 1.000. And today we went a little bit below par, and I'm still holding long. This is extremely oversold, and we probably were reaching for par. And now that we're there, I expect bears will take some profits and that will bounce. I did the same thing with bonds. I might have to do this. I did the same thing with bonds down here. It's so oversold. We're probably going to get a pretty good bounce. So I did that with the euro yesterday, looking for a couple weeks up. And if it goes lower, I'll buy more. Wedge 5.17, but a bull bar 21. So bulls are not going to sell 21 low, but as 22 goes down, more and more bulls will take profits. Will the bears sell below 22? I think it's going to be a minor reversal, and the bears do not want to sell too low. So it's a problem for the bears. Okay to get out of longs. 5 points below a bull bar 21, 1 tick below a bear bar closing below its midpoint 22. But for me, it's too low to sell. Might be buy the close 22. Bulls don't want the market to go below a bear bar. So if they see a bear bar, they buy the market, trying to prevent the next bar from going below. They know if it goes below, more bulls will sell. And if you start to have a lot of bulls selling, you could get a fairly deep pullback, like to that breakout point. High 122, but a bear bar, sellers above, and possible wedge 17.20, probably sellers above 20. High 122, but a bear bar, sellers above, and possible wedge 17.20, probably sellers above 20. $16 is probably the start of a trading range. It's the start of a channel, and we could go a lot higher, but ultimately, I think 16 will be the start of a trading range, even if we go higher first. Consecutive bear bars, bear bar closing near its low, more bulls exiting. Some bears might sell, but I think you're only selling if you can use a really wide stop and scale in. probably a minor reversal back below yesterday's low, maybe all the way down to the breakout point. Possible high of the day, a big low 2, one pullback 2, but more likely a minor reversal down to the 74 low. Remember I said we should fall back below yesterday's low and possibly down to the 5 high, the breakout point. Probably not much more than that. This is 24. The second hour began with 13 low. Well, here's the second hour's range, and the midpoint of the hour is there. The bears are trying to get the hour to close below the midpoint. That would increase the chances that it would go lower. Bulls would like the hour to close above the midpoint, and that will increase the chances that the bottom of the range will be around where we are. 3 consecutive bear bars closing near their lows, but only one close below the moving average. It's probably sell the close, betting the first reversal back up will fail, but I'd rather sell higher. And for the bulls, 3 consecutive bear bars, the first reversal up probably will lead to a second leg down, and therefore the bulls should wait for a second reversal up, a high 2 or a micro double bottom before buying. Is the rally strong enough so that you can buy above 24 or 25? I don't think so. I think it's better to wait for a second reversal up. Bears, why would they sell here if it's going to be a trading range? Because they know one of two things will happen. If they sell, it'll go down, they can make a profit. It'll go up and form a lower high, they can sell more, and it will come back down to their first sell at the 24 close. They could get out break even on their first sell and with a profit on their higher sell. Remember I said trading range was most likely after 16. I said I didn't know if 20 would be the high of the range or if we'd go up higher, but probably trading range. Bulls, breakout test, 5 high. Lower low double bottom, 16. Why would bulls buy above 25? Well, we're still always in long. And sometimes breakout tests are very abrupt. We had one a couple days ago over here. I talked about that at the time. We had a double bottom. It could be a buy the close bar. Even though it's a big bear bar, there might be more traders buying that close, betting on a double bottom pullback in a rally. And this is also a test of support, moving average and 5 high. So there are bulls buying the close. We don't yet know if there are enough bulls buying to resume the bull trend. I think this is not going to be the high of the day. I think we're going to get one more new high. So it might be a bigger wedge, 5, 21, and maybe 40 or something. The market often tries to get a midday reversal. And it often comes from a wedge. Midday, 81 bars to the day. Middle of the day is bar 40, bar 41. So it's often, you often see a rally on bar 41 and a little wedge. Middle of the day, bar 43. Rally for the first half of the day, sold off second half. A wedge, bar 41, perfect middle of the day. Around the middle of the day, I don't know if that's exactly 41, but a wedge rally. Here, bar 50, a little bit later. Bar 37, a little bit earlier. And the same is true with sell-offs. If you have a possible wedge on a sell-off, you'll often get a midday reversal around bar 40, 41. Here, a big sell-off or a parabolic wedge, midday reversal. Bar 49, a little bit after the midday. bar 36 a little bit before, bar 40 almost exactly midday, bar 40 exactly the middle of the day, bar 43 a little bit later, bar 38, bar 39. So that's why I think we may get one more new high and then a big wedge, 1, 2, and 3. So when the market gets around bar 40, if we're up here, look for a possible sell for a midday reversal. And the goal would be a couple legs sideways to down, possibly a sell-off for the remainder of the day. For the bears, it's already a wedge. We have four good bear bars, all closing on or near their lows. So you'll have bears selling more higher. Bulls, I'd wait for a second reversal up. Probably sellers above 25. It looks like we're going to dip below the 5 high, but a trading range is still most likely. So remember I said this is a big enough bull surprise so that it's probably major, and that meant that one of two things would happen. We would get a pullback to a bull flag and then go up, or we get a pullback in the form of trading range, and the pullback could be pretty deep. A major bull surprise affects the remainder of the day. A minor bull surprise leads to, in effect, the next 5 or 10 bars. A major bull surprise affects the remainder of the day. So usually it leads to either a trading range or a bull flag. This is similar to today. Here we just kept channeling up all day. Major bull surprise. But sometimes a major bull surprise like that will have a very big reversal and the day will become a trading range. It can become a bear trend, but it's much less likely. But this is what is possible. We could have a very big, relentless pullback, and then the day becomes a trading range instead of a bull trend day. Very big bull surprise and big sell-off to a trading range. Sell the close. I'd get out 5 points above a bear bar, 1 tick above a bull bar closing near its high. But you can also hold short, stop above 20, and sell more higher. 21, a bad sell signal bar. So we're probably going to get back to the 21 low at some point. Not necessarily in the next few bars, but at some point today we'll probably get there. This might become a wedge bull flag. So 1, pullback, 2, bounce, 3. Bears, if they sold below 23, they're able to make 10 points. So you'll get some bears buying back shorts here. When you're scalping, I remember back in the 90s, the average day was about 8 points tall, and I was scalping for 1 or 2 points. And then in the 2000s, the scalps were 2 to 4 points. And now the average day is 50 points or so, and scalpers are scalping for 5 points or 10 points. And in 20 or 30 years, they'll probably be scalping for 50 points. A scalp usually means about 5%, maybe 10% of the day's range. Are we always in short yet? 4 consecutive bear bars, 2 closing below the moving average. We're probably always in short, but that does not mean bear trend. It just means we're probably going lower. So it's not all that bearish. The bars are not all that big. Look at the size of the bear bars compared to the size of the bull bars. So yeah, there are a bunch of bear bars, but they're not particularly big. Probably a minor reversal and probably a trading range since 16. We looked for the top of the range. Well, we found it. And now we're looking for the bottom of the range. With 4 bear bars, we're probably going to pull back below the 5 high. I'm going to Well, I'll keep that measured movement for the time being, but I'll take a look at a 50% pullback. So that's right below the 5 high. That's probably where we're going. Getting vacuumed down to the 5 high and the 50% retracement. Can the bulls start to buy below things and scale in? You can do it if you're a computer, but if you're an individual trader, you'll mess up. If it keeps going down, you'll panic out instead of buying more. And the computers will buy more. They'll trade small and buy more. Probably a minor reversal above 26, 27. Can you buy it? Like I said, you'll probably need a wide stop and you have to scale in. Can you sell the 26 high? Same thing. You need a wide stop and you'll probably have to scale in. So this is not good stop entry trading if you're not able to use a wide stop and if you're not able to scale in. If we start to go sideways and get a high 2, that would be a decent buy. And for the bears, I think they'd rather sell a lower high than down here. The bodies are getting smaller, 24, 25, 26, and 27 might even be a bull bar. So as we're going down, we're having more buyers and fewer sellers. So do you want to be selling down here? No, better to sell higher. Stops, they'll probably be scalps. Traders, the bars are getting very small. Scalps right now, probably 5 points. I haven't mentioned 3,800, but it's a big round number, and that's a magnet, and we're right there. Back below the breakout point, bears are hoping that we sell off relentlessly. They're hoping that we do this and this. I think we're always in short right now. And it's sell to close, but only if you can use a wide stop. Bulls trying to get a high 2, 28, 28, 26. But they'll need a pretty good bull bar. And even then, the channel is pretty tight, and we have a lot of bear bars. So traders will sell the first reversal up. High 2, 26, probably a minor reversal. So if you buy it, you're looking for 5 or 10 points. And can you sell the 28 high, 28 close? I would not. We're probably forming a trading range. If you buy the 28 high, where's your stop? Well, most traders would put it below 28, but it's probably better to use a wider stop. And most of the bulls are hoping we get bar 12, bar 13. They know we're not going to get it, so they'll scalp out 5 points, maybe 10 points. Bulls, some will take partial profits at 5 points. Some will take partial profits at 10 points. Some will hold, taking a chance that we make a new high. But I would take at least part off at 5 or 10 points because we'll probably get a lower high. We're probably forming a trading range. You can see it's almost exactly a 50% pullback. Is it back to always in long? I'd like to see a couple bull bars closing above the moving average. Can you sell 10 points above 28, betting that a lot of bulls will take profits there, and you might be able to make 5 points on the short? I still think we're going to form a lower high in a trading range. So I do think bears will sell 5, 10, 15 points above the 28 high. Who's selling here? Well, right now, it's bulls. The bulls hoping to make 10 points, unable. And then they quickly sold, trying to make 5 points. Now they're trying to make 2 points, 1 point. So this is bulls panicking out of longs. They were hoping for something that they did not get. And now they're trying to get something. The bears sold 5 points above 28, and they tried to sell 10 points above, unable. And this is mostly an absence of bulls buying up here, and the bulls who were long then started to take profits, and that created that tail 29. Bears double top 25, a low one, about 50% pullback. Decent bull bar 28. We're still always in short, so theoretically the bears have to sell again if they're trading always in. Sell below a bear bar closing near its low, sell at a new low 28, but trading range. I think we're probably in the trading range, so there probably will be limit order traders looking to buy 29 low, 28 low, buy lower. So probably buyers below 29, 28 I would not sell. And for the bears, the limit order bears, they sold 5 points above 28. They needed to fall one tick below the 28 high to make their scalp. And it probably will, because we're probably in a trading range since 16. And in a trading range, the market typically rewards limit order traders. For the bears, a low one with 2 bull bars, 50% pullback, 3,800 big round number, and unimpressive selling. So probably buyers below 29, 28, and probably sellers above where we are, maybe around 21 low, maybe a 50% pullback of the sell-off. So that's 50%. You can see we went just a tick or so above it. That shows you that there were a lot of bears with limit orders to sell 50%. That's part of the reason for that tail. I'm going to get rid of this measured move. I don't want too many lines on the chart. So when you look at it, it's similar to where we were down here. What do? It might go up, it might go down. It's not strongly bullish, not strongly bearish. If it goes down, traders will buy it. If it goes up, traders will sell it. So probably trading range. The bears are hoping the bottom of the range is here, but right now it's more likely around here, maybe a little bit below. The bears are hoping that what we have now is this, an attempt to go up, but it doesn't go very far up, and then we get another leg down. I talk about this all the time. Whenever you are waiting for more information, waiting for bars to close, that's your radar telling you that the market's in a trading range. It's not clear, and when it's not clear, traders prefer to buy low and buy more lower. They want to sell high, sell more higher, and they tend to take quick profits. So for the bears, a low one, but 2 bull bars, probably buyers not far below 30, probably buyers below 28. And for the bulls, they're hoping this is a resumption of the bull trend, but a bear bar after a tight bear channel, probably sellers above 30, sellers above 29. Not good for stop entry traders right now. So better to wait for maybe a double bottom 28 or a double top on 29. Whenever you have a bull trend, and then you get a surprisingly big bear bar, 55, and then that follows through 56, 57, you have to wonder if it's a trap. It's pretty common for a bull trend to get a trap late in the day, and it's pretty common for a bear trend to get a big bull bar late in the day, and it's a trap, and the bear trend resumes. We've been in a trading range since 16. We had a strong rally. And I said the most likely thing that would happen would be we would get a trading range, but that we might get all the way up to the 60-minute moving average. We still might get there, but I do not think we'll break much above it. If we get above it, it'll only be a little bit. The day's range is already big, about 80-point range. You can see on the daily chart, it's already a pretty big bar, about as big as most of the other ones over the past month. So it's probably not going to get much bigger. By the close since 57, 58, 59, 60, but possible double top 53. Bears, nothing to sell. We're back to always in long since 50, 7 or 58 or 59. And a lot of the bulls will scalp because we're still in a trading range and we have not broken out. And we're probably not going to break strongly above the high of the day, because to do that would require a strong breakout above the 60-minute moving average, and that's not likely today. What do you do here? Well, it's buy the close, but I think when you have a trading range, we've been in a trading range, as I said, since 16. This is the market since bar 16. We had a good rally here, a good rally here, but it's still a trading range. So when I'm buying in a trading range, I want to buy low and scalp out 5 points, 10 points, and not buy high, hoping the trading range will break into a trend. And I'd rather sell high. And if a rally is reasonably strong like this, I'm not going to sell the first reversal down. I want some kind of a micro double top. Over here, we had an II 44, 45. Remember back over here, I said we might get a wedge top around the middle of the day, around bar 41. It came at 43. And I said, look for a reversal down. And we've had a couple legs down. We got near the 28 low at the start of the channel. We have a spike pullback channel. And that usually converts into a trading range. So spike pullback channel. Normally you get a test down to around the start of the channel and then a bounce in the trading range. But we've already been in a trading range since 16. Bears double top on 53, top of the sell climax high 55, but 5 or 6 bull bars. So not worth shorting 61. Bulls, if they are hoping we get the new high, they can hold long and get out 5 points below 61. They can get out below 56. But I think it's probably better for the bulls to scalp out 10 points above 56 or 57 and then wait for a pullback and buy again, or wait for a very strong breakout above the top of the range in the 60-minute moving average. But that is not likely. This little nonsense thing that TradeStation has is really it's annoying. I don't want that pop-up. It's a useless pop-up. The bears want double top 53 or double top 43 with 6 consecutive bull bars, 5 of them closing on their highs. Traders will buy the first reversal down. Bulls, they can get out 5 points below a bull bar, 61. If 62 is a bear bar, they can get out below 62. But most traders are not going to short below 62. Some bears might sell with limit orders, 52 high, and scale in higher, thinking that we're probably not going to go much above the 60-minute moving average. But stop order bears, they should wait for it to stop going up, start to go sideways for a few bars, get a micro double top with a good sell signal bar, and then sell. And the sell will be for a scalp. Near the top of the trading range, so you'll have fewer bulls willing to buy closes, and you'll start to get some limit order bears selling, for example, selling 53 high. First reversal down, probably minor. The bears want a head and shoulders top. When you have a wedge rally, 1, 2, 3, you expect a couple legs down, and we've had 2, 1 pullback 2. But sometimes the 2 legs down is actually the first of 2 bigger legs down, and you get a bounce and then a bigger second leg down. In any case, after a wedge top, you expect 2 legs down, and the bounce after the first leg down, either here or here, usually forms the right shoulder of a head and shoulders top. Wedge top, 2 legs down, 1 pullback 2. You can get many legs down, but you're typically expecting probably 70% chance you'll get a couple legs sideways to down. And that first leg down, you have a pullback and a second leg down. And the pullback from the first leg down is usually the right shoulder of a head and shoulders top, and the second leg up of the wedge is the left shoulder. Another example of wedge, 1, 2, 3, 2 legs down, 1 pullback 2. The pullback from the first leg down forms the right shoulder, and the second leg up in the wedge is the left shoulder. Another example of wedge, 1, 2, 3, 2 legs down, 1 pullback 2. The pullback from the first leg down forms the right shoulder, and the second leg up in the wedge is the left shoulder. Wedge top, second leg down, right shoulder ahead and shoulder stop. Another example, a small one. Another example. 7 consecutive bull bars, most of them closing on their highs. Looks like we're trying to get up to the 60-minute moving average. But as I said, with all the trading range trading that we've had since 16, I do not think we're going to break strongly above the 60-minute moving average. Today, I don't think we'll do it today. Daily chart, I think we're going higher. I think we have a double bottom, we have a double top. I think we'll go up at least another day or two. Bulls are hoping it's a double bottom, higher low, major trend reversal, and we go up here or up here. And the bears are hoping it's a double top, and this is a pullback, and we go down. I do think we're going to finish the year somewhere up here, so I think it's bear channel, bull flag, and then we break out and rally the second half of the year. But I'm not confident that the bottom is in yet. It might be, might not be, we don't know yet. A lot has to do with earnings. We're entering earnings now, so that could lead to one more new low, and it could lead to a strong upside breakout and the start of a trend up to the end of the year. I've said a few times that I would not be surprised if the market stays sideways into October, and then October we rally into the end of the year. The market, the most bearish time of the year is August, September, October, and traders look for a sell-off in October. They don't, maybe they get it half the time, but they want the sell-off in October, and then they buy, and they expect the market to be sideways to up into the spring, May or so. And that's why you hear the expression, sell in May and go away. And when do you come back? You come back after a sell-off in October. That's the ideal situation. It rarely ever works out. But that's a general idea that August, September, October tend to not rally. There's an increased chance of big sell-offs during those months, and then a tendency to rally into the end of the year and then into the spring. I never trade calendar trades because math is just not all that good. There are many other things to trade that have much better math. Well, it's kind of like a secret handshake. If you're a trader, you want to feel like you're part of the club, and you have to know the secret handshakes, and that's one of the secret handshakes. Bears double top 52, lower high major trend reversal, with 7 consecutive bull bars and 6 of them closing on their highs, probably buyers below 63. Okay for bulls to get out, a tick below a bear bar closing below its midpoint, or 2 or 3 or 4 points below any bar. But for the bears, it's a low probability short. I would wait for 2 or 3 bear bars, or wait for it to go sideways and get a micro double top. What happens if 63 closes on its low? Can you short at that point? I still wouldn't do it after 7 bull bars. Reasonable to get out of longs, but not good enough to short yet. You cannot simply look at a bar. It's a good bar for the bears. You have to look at the context, and that means the bars to the left. And the most recent bars are the most important. The bars to the left were at the top of our trading range, good for the bears. But we also have 7 consecutive bull bars, 6 of them closing on their highs. Bad for the bears. So I would not sell here below 63. For the bulls, a high 164, but 2 bear bars, probably sellers above 64, 63, and 41, the high of the day. Now, I said that if we get 2 or 3 bear bars, you can short even without the micro double top. We have 2, but they're not very big. So I'm still not willing to take the short. Now, if bulls did get out below 63 and they're trading always in, they have to be always in. They got to quickly get back in, either long or short. 64 is not good enough reason to sell, and it's not a good high one. So the bulls are looking for one of 2 things. A bull bar closing near its high, maybe 65, buy above that, or buy above the most recent high, 63, which is also where the bears will give up. The problem with it is we're still at the top of a trading range, and buying with stops at the top, especially above the bear bar, it's a low probability bet. There probably are more sellers than buyers above 63, above 43. As I said, I think we're probably not going to break much above the 60-minute moving average. We might go a little bit above, but not much above. Here's the 60-minute chart. We have a double top, we have a double bottom, but past 5 bars are not all that impressive. In fact, the entire day on the 60-minute chart is not all that impressive. We've had 1 bull bar closing near its high, but it's not very big. All the other bars had hesitation. Here we broke above the 60-minute moving average, maybe 5 or 10 points, but could not hold above. That's what I'm saying. We may go 5 or 10 points above, but I doubt we're going to go 20 or 30 points above today. Bears, they're still short, below 63. Others will sell below 64. If 65 is a bear bar, they'll sell below 65. But the 7 bull bars are strong enough so that I think this reversal will probably not get much below the moving average. So I'm going to wait to sell. Now, isn't 55 a big enough bear surprise to get a second leg down? Sometimes you get a big bear surprise bar, and the market will go above the top of the bear surprise bar and then get the second leg down. And that could happen here, but I keep coming back to the problem that I have with the number of consecutive bull bars and the number of bull bars closing near their highs. I'd rather wait for a second reversal down before shorting. I want bulls 65, but I think bulls will want a bull bar closing near its high to buy above the top of the range. Confusing trading range. You'd expect the probabilities to hover around 50-50 for everything that you do, but that's the nature of a trading range. You get a lot of reversals. That's high probability, but stop entry setups tend to be uncommon or less common. You get more limit order trading than stop order trading. We've had a lot of trend trading today, but we have been in a trading range since 16. Micro double top, 43, 45. Micro double top, 52, 54. And this is only a single top. Bears are trying to get 3 bear bars, and they have it. They're hoping we do that. But I'm still not willing to short, and I do not want to buy with a stop above 65. So I'm going to wait. It's really important to wait. I talked earlier today about the single biggest reason why traders lose money is they take trades that are not very good. They're too eager to trade. They're focusing on taking trades instead of on making money. And I always focus on the making money. And sometimes it's easy. I take a whole bunch of trades in a very short period of time. Sometimes it's hard, and I'll just wait. bulls trying to get a high 166. 3 consecutive bear bars closing on their lows. Sometimes 2 or 3 bear bars, the bulls will give up, like 23, 2 bear bars, and the bulls gave up 24. But it looks like the bulls are not giving up here. We had 2 bull bars 64, did not give up. 2 bear bars 64, did not give up. 3 bear bars 65, and we're still not getting a big bear bar closing on its low, which would be a sign that the bulls are giving up. They're not giving up. This is about a 50% pullback. We're at the moving average. They're trying to get a high 1. They want a bull bar closing near its high. But a lot of bulls might wait for it to go more sideways after 3 consecutive bear bars. Bears are buying back shorts. They're concerned that we're not getting a big bear breakout. The bulls are not giving up. So now the bears are giving up, and that's what's turning 66 into a big bull bar. The bears have sold 63, 64, 65. They don't like it failing to break to the downside, like 55, and more of them are buying back their shorts. Can you buy outside up above 65, above 66? That's pretty high up in the range. It would have been better for the bulls if 66 was smaller. Can you buy above 66 and put a stop below 66? If you do, I would trade small. The alternative, wait to see if it goes sideways for several bars, 3, 4, 5 bars, and then look to buy or sell. Or wait for a strong breakout up or down. It looks like we're going higher, but I'm not sure that we're going much higher. And the next target, the 60-minute moving average, is about a measure move up from where we are. So your reward is up to here, your risk is the same. To take the trade, you need at least 60% probability just to break even. So it's not very good math. You can always buy above 66 and hold for a swing, hoping that we get 12, 13, 14, 15. But we're in a bad location for the bulls. So good-looking bar, just like 63 was a good-looking bar for the bears, but bad context, the top of a trading range, right below the 60-minute moving average. Might be more sell the close bears, just like 55, I wrote that there might be more buy the close bulls, betting on a bear trap. There might be more sell the close bears, betting on a bull trap, and they're looking for a second reversal down. This is kind of like earlier in the day, 2 and 3 big bull bars and went above the high of the bar and reversed down. I would be either, I'm flat, but I think flat's the best choice. Second best choice is long. We're still always in long. However, the stop is 15 points below, so you have to trade really small. And there's nothing to short. If we get a decent sell signal bar 67, some bears might short, betting on bull trap, like 2, like 4. But right now, I'm not planning to do anything other than wait and hope that it goes sideways for several more bars. The bears who did sell the market on the close of 66 have made 5 points, but I suspect they'll be happy with the 5 points and they'll buy back their shorts, and that could put a tail on the bottom of 67. Right now, it went above 66, an outside up bar, a breakout above 63, so it's on the buy above 66. But as I said, I think it's not a very good buy. You're risking too much, and you're probably not going to make much profit. The bulls need 67 to not be a bear bar. So even if it's a perfect doji bar, the odds will favor the rally continuing up to the 60-minute moving average. The one thing the bulls do not want is a bear bar, even a small bear bar. It'll make a lot of bulls give up. Just like 55, the one thing the bears did not want was any bull bar, even a small bull bar. And there was a small bull bar 56, and then a bigger bull bar 57 as more and more bears gave up. And if we get even a small bear bar 67, you'll start to get bulls giving up. Tight trading range, bad for stop entry traders. Always in long, but too much risk, right below resistance, so not a lot of reward. So really not very good. Still on the buy above 66, but not very good. I get out below 67. And for the bears, the big tail, 67. We got the low 2 top, double top 63, but the tail after the big bull bar, that's not very good. A lot of the bears will want a second bear bar closing very slow. Just like 56 was not a good buy, but 57, the second bull bar, was. Very big bear bar, but opposite problem of 66. I said I did not want to buy above 66 because it was the top of a tight trading range and it was a big bar, so low probability, big risk. And I don't want to sell below 68 because it's at the bottom of a tight trading range, 62, and a big bar, so big bar, big risk. Not good for stop entry traders. Remember I said that we had 2 legs down, 50, 56, but it was not all that many bars, and it could be a complex first leg down. This could be a pullback and the start of a bigger second leg down. But too many good-looking bull bars makes me only want to sell if the sell setup is perfect. And 63 was not perfect, 7 bull bars. 67 is not perfect, a tail. And 68 is not perfect, a tail, bottom of a tight trading range. So not good enough for stop entry traders. If the bulls are lucky, they'll get a bull inside bar, 69, closing near its high, and the bar it will not be too big. And for the bears, it's harder to construct a good stop entry scenario for bar 69. For 69, the bigger the bar gets, the fewer bulls will take the buy. So it's still a buy. You got a double bottom, 68. It did not fall below the 66 low. The bulls triggered a buy above 66. 67 went above 66. The bears tried to run the stop and unable. So that's the buy. And the bulls are hoping that we go above and up to the 60-minute moving average. For the bears, they have a low 2, 67. They have a low 1, 69. They're hoping 68 is the start of a bear trend, but I don't want to sell below a bull bar when the market's always in long. So you either buy above 69 and hope that we race up to the 60-minute moving average, or you wait. What happens if it goes above 69, which it probably will, and then quickly goes below 68? Will the bears short? Below 68, double bottom 66. I would not. That's selling too low in a trading range. I would probably wait to see what the breakout looks like and then sell. You can see the limit order trading, right? They're selling above things, above 63, above 65, above 66, and they're buying below things, 63, 64, 65, 67. So there's an unknown number, but a lot of bears willing to take a chance that this is a bull trap and that they'll sell above. Stop entry traders is a credible buy, but you're hoping for the quick breakout above 67. This is a smaller version of this. You buy above 2, but your stop is down here, and you have to sit through a big pullback. You buy above 4, but your stop is down here or here, and you have to sit through a big pullback. So the probabilities are not good. Stop is relatively far below 68, so a little bit more than 10 points. Bears are hoping for a small head and shoulders top. Sometimes you'll get a nested head and shoulders top where one or more of the tops is also a smaller head and shoulders top. And here we have a head and shoulders top, left shoulder, head, and right shoulder. And the right shoulder is subdividing into a smaller head and shoulders top, left shoulder, head, and right shoulder. So the bears are trying to get 70 to close on its low. If they do, it's reasonable for bulls to get out below 70 instead of below 68. And bears will take a chance and sell below 70. Some will wait for it to break below 68. So that's what we're deciding. Are we getting a nested head and shoulders top where the right shoulder subdivides into a smaller head and shoulders top, or are we resuming the bull trend? Getting late in the day, traders are deciding, will the day close near its high, which is more bullish, or will we sell off at the end of the day and close in the middle of the range, which would increase the chances of sideways tomorrow? Everybody's deciding, is it a head and shoulders top or is it a bull flag? 71, important bar. The more it closes on its low, the more traders will sell below, bulls will give up. If it has a tail, the bulls will continue to use a wider stop, 68. We're waiting, trading range behavior, just waiting. Bulls, they can get out below 71 or below 68. And bears, some bears will take the short. I think it's okay to take the short, but it would have been better if 71 closed at or below the moving average instead of right above the moving average. Some bulls buying the market, trying to prevent 72 from going below 71, because they know if it goes below 71, a lot of bulls will exit. Trading range behavior, so you'd expect it to go below 71. Now, what will the bears do if 72 is a bull bar? They'll probably get out. It's forming something of a triangle. We have two lows here, possibly a higher low here. Breakout mode. We've been in breakout mode for 10 bars. We have a credible buy 69, a credible sell 71. Some bulls are keeping their stop below 68. Some bears will short below 68. Some bears will short below 71. Well, I would not short below 71. It's too close to the 68 low. So I'd either sell below 68 or wait to see what the breakout looks like if we get the breakout. And for the bulls, they're hoping to get a second reversal up, a double bottom pullback. Double bottom 66, 68, and then a pullback 72. But they need a good buy signal bar. It's common for the market to try to make a move at the end of the day around 12:35. It's on a sell right now, but the bears need the breakout below 68. What's the target below? Well, the 56 close, the 55 close. We had a bear surprise bar, and we never tested the close adequately. So there are still some scale end bears who sold below a bear bar 63, hoping to get down to this 55 close. And that would put a bigger tail on the top of the bar on the daily chart, make it less bullish. Not sell the close, but I do think there'll be bears selling below 68, or they'll wait until it breaks below 68 and then start selling closes if they get 2 or 3 or 4 consecutive bear bars. And the bulls, they need a good buy signal bar or a double bottom pullback. A good buy signal bar, a bull bar closing near its high and at or above the moving average. Can you buy the 68 low, betting that there'll be buyers below, given that we're in a trading range? In general, when you have an obvious stop location, 50-50 chance there'll be buyers below, and 50-50 chance there'll be a successful breakout. So it's reasonable to buy the 68 low. I think it's better if you're doing something to get short, but it's not yet a high probability short. The bears are trying to get down to the 55 close. Some buyers here are 10-point bears who sold below 71. The stop order bears below 68 have not been able to make 5 points yet. They're trying to get down to the 55 close and make 10 points or more, 15 points. I bought above 69, exited below 71, sold below 68, and scalped out 5 points and back to flat. But I'm willing to sell again. I'm not willing to buy at the moment. The reason I scalped out 5 points is it's where the bears who sold below 71 would be exiting with 10 points. So you have other bears looking to buy here. This is pretty good. The bear bars are getting bigger and closing near their lows. And 55 close, a magnet below. Sell the closed bears never had a chance to get out after they were disappointed at 56. Bulls, they don't want it to come back, so I'd get out this late in the day. I'd get out above the high of the prior bar, 73. What about getting out break even? I personally, I got out. I took my 5 points because my concern was we're getting low in our trading range, and the bears made 10 points selling below 71, and it's usually hard to make much more than that when you have a fairly tight range. You can see in a trading range, when things look bullish, 66, 69, they sell. And when they look bearish, they buy. Now, what about buying above 74? A failed breakout below a double bottom. Now we got 3 good-sized bear bars, and they're increasing in size, so I'm not willing to buy with a stop. And I used a limit order to get out of shorts around the close of 73, but I did not reverse to long. So I'm flat, and I'm not going to buy above 74 after those 3 big bear bars. Remember, we're in the time frame around 12:35 when the market often tries to trend into the end of the day in either direction. The bulls are hoping we get up to the 60-minute moving average, but those 3 bear bars lower the chance for that. A failed breakout below a double bottom is basically a type of wedge. You had 3 legs down, 66, 68, and 73. I use the term wedge loosely because wedges are rarely ever perfect. I'm just looking for 3 attempts to do something and having them fail. So for the bulls, you can call it a high 2, 69. It's a good bull bar. But with the 3 bear bars, the probability is not as high as I want. Wedge, sometimes you get a perfect triple bottom. Sometimes you get a higher low, it becomes a head and shoulders bottom. Sometimes you get a double bottom pullback. Sometimes you get a triangle. Sometimes you have a double bottom and a breakout below. And then sometimes you get a regular traditional wedge with 3 lows. But I think these are all variations of the same thing. The bear's trying to do something 3 times and failing. So they stop and they buy back their shorts, and bulls buy betting the bears will give up. Did not trigger the buy above 74, so theoretically the stop order bears are still short, but I think it's better to take the profit and wait for tomorrow. Bulls are trying to get a wedge now, 68, 73, testing yesterday's low. Bulls hoping to get a good buy signal bar of 76, and then a race up to the high of the day in the final bars. I think the math is not worth it. The market has been becoming increasingly quiet since 16, and especially quiet since 46, the second half of the day. that reduces the chances of a big move up or down. Bears, I'd get out above the high of the prior bar at this point, this late in the day. So above 74, 75, 76. And for the bulls, I don't think it's worth buying, even though it's a wedge, 68, 73. I don't think there's much profit potential. There's just no energy. The market thinks this price is just about right. We've been at this price for 60 bars, and it's unlikely that in the final few bars, traders are suddenly going to decide the price is terribly wrong. A doji bar, after a lot of pretty good bear bars, that's not going to attract many buyers. Bears, I'd get out above any bar, 76. At a minimum, the bears are trying to get the day to close below yesterday's low. That would be some sign of strength. They'd like the day to close below the midpoint of the day's range, but the day to close below the midpoint of the day's range, but you know, they might get it. But anyway, when a day is not going to close on the high and it's not going to close on the low, it often closes around the middle, which is right here. End of the day, volume picks up and the speed can pick up as well. But I think best choice here is exit shorts and wait for tomorrow. That's an 00 right at the end of the day, but I think it's better to wait until tomorrow. Outside bar 77, bigger outside bar 78. It's a breakout mode setup, so theoretically you sell below right here, or you buy above, and I think it's better to wait. The bears are trying to get down to the 55 close. Today, I think, had several interesting things, and several things that were worthwhile. On the open, we had a big gap down and a good-sized bull bar, but I said the tail was fairly prominent on top, and I said that increased the chances of a trading range open. So by the close, yeah, but I think it's going to be a trading range open. And then bar 2 is a fantastic bar, a huge bull bar closing on its high. But I said the problem with it was traders don't want to risk too much. And if they buy above 2, the stop is below 1, and that's risking a lot. So a lot of traders will not take the buy. Instead, they'll place a limit order to buy a 50% pullback, or they'll wait for a 50% pullback and then a reversal up and then buy. The bears wanted a low 1 below bar 3, a buy climax and a reversal, and that would have been a good short if it was very close to the moving average. But since it was not a good short. They scalped for 5 points. The bulls bought a 50% pullback, and then we got a very big bull bar 4. So pretty unusual, 2 and 4, exceptionally big bull bars closing on their highs. 4 outside up, a resumption of the bull trend, but the same problem that we have with 2. A lot of traders simply don't want to risk too much, so they do not want to buy above really big bars. They wait for a pullback and buy the pullback. The stop order bulls who bought above 2 and waited for the pullback would not have bought above 4. The stop order bulls who bought above 4 waited for a pullback, and most of them did not want to buy above 11 because it's a bear bar and it was a 7-bar bear microchannel. However, on the open, double bottoms are common, and the second leg down is often climactic. It's often a wedge, and this is both a 7-bar bear microchannel, so it's a sell climax. There's also a little bit of a parabolic wedge, 7, 8, and 11. So I want to buy, but I want to buy above a bull bar. So the buy is above 12. If you want, you can wait for consecutive bull bars, 13. Probably always in long. The bears will try to get double top 5 at the moving average, but I think it's probably going to go up. I think we'll get above yesterday's low. Maybe we'll get a measured move up from the double bottom. 111. That would get us to yesterday's close. But I do not think we'll break above the 60-minute moving average. It's possible that we could get a little bit above it, but probably not strongly above it. Tail on the top of 13, disappointing. Tail on top of 14, disappointing. Close at the moving average 14 and not above 13 and not above 5, all disappointing. And it's a warning that the trend may not be as strong as bulls want. It's 5 to close, 12, certainly 13, 14. Then we get the breakout 15, far above the moving average and back above yesterday's low, so we close the gap. And this is, I think, a major bull surprise, 12, 13, 14, 15. So it's a bull surprise, and it's exceptionally big. Usually a bull surprise will affect the next 5 or 10 bars. But when I think a breakout up or down is strong enough to affect the remainder of the day, I call it a major surprise. And I think this is strong enough to affect the rest of the day. And when I say that, I mean the day is probably not going to be a bear trend day. We could get a bear trend, but probably not. We're probably not going much below 1 if we get there. Probably if we sell off, let's say we sell off down to a little bit below 1, the day will probably reverse up and form a trading range day. So when you get a major bull surprise, you're looking for one of two things: a strong bull trend or a trading range day, a reversal that retraces much of the strong breakout, but then the market goes sideways. Bad follow through 16, micro double top 17, and I said I would not sell below 17 or 18. I'd wait for a second reversal down. For the bulls, 19, a high 1, but a 4-bar tight trading range and 3 bear bars. And if we go above 19, we might reverse down from a wedge with 5 and 17, so not a very good buy. And we broke out strongly on 20, but big tail. We tested yesterday's close, we went a little bit above it, and then we had the inside bar 21. Bears got a bear bar 22, and they got a second bear bar 23. Reasonable for bulls to exit below 22 or 23. And for the bears, it's probably a minor reversal. We'll probably go down and test the breakout point above 5 and then bounce. And we did get down there, but it was an 8-bar or 9-bar bear microchannel. So actually it's not. It was a 7-bar microchannel for 26 and then a high 2, 28. 28 dipped below the 5 high. That means the limit order bears are sold 5 and sold more higher, 5 points higher, 10 points, 15, 20 points higher, or below a bear bar 22. We're able to get out break even on their first sell and then with a profit on their higher sell. So that increases the chances of a trading range. Also, the size of the sell-off, big up, big down, creates big confusion and a trading range. So a high 228, breakout test, reasonable buy, but probably a minor reversal up after so many bars down. 30, I would not sell it. 32 is a low 2, a lower high major trend reversal, but 2 bull bars. 4 of the past 5 bars are bull bars, so I would not sell below 32. A big bear bar 33, but it might be a bear trap. It might be a buy the close bar. And then 34, a bull bar closing near its high. Higher low double bottom 31. Looks like we might be in a bull channel. We might simply be sideways, but traders will either buy about 34 or 35, 36, closing on their highs. And then we had 40, 3 sideways bars, a high 1, with 5 consecutive bull bars here. We're probably going higher, but I think that if we get above 20, which it looks like we will, we'll probably have a wedge top with 5 and 21 and a midday trend reversal. So around bar 41, bar 40, 41, maybe a few bars before, a few bars later, I would look for a wedge top. We got a big breakout 43, breaking above this bull channel, but we have a tail on top and possible wedge 1, 2, and 3. Then we had the II 45. But if it goes up, I think it'll be a final flag. And it did. It went above 45, but then quickly went outside down. I would sell below 45 or below 44 and take a chance that we get a couple legs sideways to down. We have a wedge, 1, 2, 3. We have a buy climax, and we have a final flag reversal. And now we have a bear surprise 46. The bull's trying to resume up above 50, maybe a wedge 44, 46. But I think we'll probably get a lower high and a second leg down. And the bears hope for a double top 47, 52. Decent sell signal bar 53. Reasonable swing sell. We may get all the way down to the 28 low. This is in addition to a wedge. It's a spike pullback channel. The market often tests down to around the start of the channel and then bounces and then enters a trading range. 55, a very big bear surprise bar. We had that report at 11 o'clock. But even though it's a huge bear bar, it's in a bull trend. At this point, not a strong bull trend, probably a trading range since 16, but it's still a bull trend. And therefore, 50-50 chance it's buy the close and a bear trap instead of sell the close and the start of a big bear trend. Also remember, this major bull surprise means that it's unlikely we're going to get a bear trend day. We may get a bear trend, we may get all the way down around below the day, but I don't think we'll go much below it. Then we had a bull bar, 58, 56, not good enough to buy, but it's a problem for the bears. And we had a bull bar closing near its high, 57. So now you'll start to get bulls buying, buy the close, buy above the high of the bar. We should get above the 50 low. You had limit order bulls buy the 50 low, buy more, 5, 10, 15 points lower. 58, not a very good bull bar, but it's a bull bar closing near its high. So it's still buy the close. And then 59 breaking out above the 50 low. So the bears were hoping for a breakout test. They were hoping for a pullback to the 50 low or just below, and then a resumption down. They were hoping the limit order bulls who bought the 50 low over here on 55 could not get out break even, and then they would panic out. And instead, we broke above. So it looks like probably back to always in long by the close. But we still, this whole sell-off, it's 2 legs down, 1 pullback, 2. But I'm not convinced that it's enough bars to reverse a wedge of this size, especially a midday reversal. So this might be a complex first leg down, and then we rally and then get a bigger second leg down. So yeah, it's by the close, but the bears will try to prevent it from getting above 43. Still by the close, and now we have 7 consecutive bull bars. A bear bar 63, a head and shoulders top, left shoulder and right shoulder. A wedge top, expect 2 legs down. It could be 1 pullback 2. It could be 1 pullback 2. And the pullback often forms the right shoulder of a head and shoulders top, and that means it's also a lower high major trend reversal. But with 7 bull bars, I'm not shorting the first reversal down. 3 bear bars, good for the bears, but I'm still not willing to short. I'd rather sell a second reversal down. Big outside up 66. But the bulls really need to break above 43 and the 60-minute moving average. And we're pretty close to both, and I don't want to be buying at the top of a tight trading range or the top of a trading range day in general, and I certainly don't want to buy above a big bar. In general, a big bar at the top of the range or bottom of the range would be a trap. So I'm going to wait. And for the bears, I'll wait for a second reversal down. And they have it, 67, but a doji. I don't want to sell that. And then the bulls have a double bottom, 66, 68. A bull bar closing near its high. We're always in long. I think it's a reasonable buy, but you're at the top of a trading range, so bulls will be quick to get out. They want a quick breakout above 67 and the high of the day. Weak entry bar 70, and then terrible follow through 71. So if you bought above 69, I get out below 60 and below 71. Bears could sell below 71 or below 68. I did both. I bought above 69, exited below 71, and then sold below 68. Big breakout to the downside. The bear bars are increasing in size. That means the momentum down is increasing, and it increases the chances we'll go lower, maybe to the 55 close. Sometimes you get a bear surprise and then a rally to above the top of the surprise, and then the second leg down begins. And this looks like an example of that. Also, it looks like a bigger head and shoulders top, left shoulder, head, and right shoulder. Bulls trying to get a reversal, 74. High 2, 69. Well, with 3 big bear bars, 2 bear bars closing on their lows and below the moving average, 72, 73. And one of the bear bars, the body's completely below the moving average. There's 0 chance I'm going to buy 74. The odds are we're going to try to go lower. And we went a little bit lower at the end of the day. So for stop entry bulls, you could buy above 1. And buying above 2, I'd rather buy a pullback. Same with buying above 3 and buying above 4. So I would not buy above 2. I would not buy above 4. Too much risk and too many traders unwilling to buy there. They'll look for a pullback. So that means there's an absence of buyers up there. Well, the bears are low 1, 3, but buyers below, even though it's a good looking bear bar. If it is at the moving average, I'd sell it. Or if it's a second reversal down, it's a sell, like below 5. But with 1, 2, and 4 as bullish as they were, I thought 5 was going to be a minor reversal. Next stop order trade, probably above 12, above 13, above 15, disappointment 16. Next stop order trade below 21 or 22. I don't think we're going to go a lot lower, maybe to the 5 high. So selling below 24 and 25 or 27, less good. Bulls could buy above 28. High 2, 26, or they could wait and buy the pullback, 34, 35, 36, 38, 40, 41, 42. I would not buy above the II 45. It's a buy climax 43, a possible midday reversal, possible wedge. I talked about that before. I stopped talking at 9 o'clock. I said we may get a wedge rally that and reversal down around bar 41. And we got it on 43. That was the high. So you could take a chance and buy about 45. I would not. I'd rather sell the reversal down below 45 or 44. I would not buy above 51. We should get a couple legs down. You could sell below 53. We got the report, 55. I would buy above 57, 58, 59, or 60. 61, 62 are also buys, but you're getting fairly high up, and we still might get a bigger second leg down, so I don't want to buy too high up. 63, I don't want to sell after 7 consecutive bull bars. I don't want to buy above 66. The same problem, 2 and 4. Not many traders want to buy it above a big bull bar, and here, especially at the top of a trading range day. I'd buy above 69. I did. I did not short below 71, but it was reasonable. I thought about reversing. I don't like to reverse. I could have sold below 72, but it was right above 68, so I decided to sell below 68. And you either get out with a limit order, 5 or 10 points down, or on a stop above 76. Limit order traders, even though 3 is a big bear bar closing on its low and a bear trend, we were still on the by the close bull trend bar 2, so probably buyers below 3 at about a 50% pullback. And can you buy below 5? No, because it's a second reversal down, so I don't want to do that and below the moving average. Probably buyers below 9, stop below 1, not great. Probably buyers below 18, probably sellers above 19 looking for a wedge, but I think it's better to be looking to buy. Could you buy below 21? What's wrong with that? 2 bull bars? Well, it's like I said, possible wedge, 5, 17, and it's also a failed breakout above yesterday's close, so I'm not going to buy below 23. Probably buyers below 30, but it's a bear bar, not good. Probably buyers below 32, consecutive bull bars. And then up here, the II, could you sell above 45 and bet on a final flag top? You can, but in a bull trend with a bull bar and a magnet above, I would not do it. And then here, you could probably sell above 50, stop above the high of the day. I think not great. And here, probably sellers above 65, probably possibly sell the close 66, not good. And that would be pretty much it for limit order trading. Where do we go from here? It's still neutral. For the past month, I think, what is this, 4 or 5 weeks now, sideways trading. The bulls trying to get a credible double bottom. The bears trying to get a credible double top. I think the market's waiting for the earnings reports over the next couple of weeks to decide on the direction of the breakout. I keep saying that I want the bear breakout below the June low because I think there'll be buyers below. And maybe we'll get down to 3,500. On TV, they keep talking about going back below the pre-pandemic high, the February high 2020. I still think there's only a 30% chance we get that far down. So tomorrow, what do we do? Well, you got a head and shoulders top, you got a trading range. The bears want to break below and a measure move down to around today's low. We still have room to these lows, the June 30th low, so we might go a little bit lower. But it's a trading range here for several weeks, and in fact, the whole thing has been sideways now for 4 weeks. There's the weekly chart. So this is the 5th sideways week. The market's deciding, is this a credible bottom? No, not really. Is it a bear flag? Yes. But if we go below, we'll probably get a wedge, 1, 2, 3. So there probably will be buyers below that low. Question from a day trading perspective, is there any difference between the various treasury products, the bonds and the ultra bonds, the UB, the TN, the ZN, etc.? Which one do you prefer and why? Now, originally, I used to only trade the 30-year bonds, and then for years, I traded the 10-year notes, and now I'm back to trading the 30-year bonds, and I really don't think it matters. I've never traded the 2 years and the 5 years, but they all trade about the same. Usually with bonds now, I rarely day trade. I sometimes enter in the middle of the day, but it's based more on the daily chart or the weekly chart. So, but I really don't think it matters whether you're trading the 10-year or 30-year bonds. And the smaller time frames, the range of the day gets smaller. So, also, it's my belief that the institutions focus on the 10-year and 30-year, and I just kind of like to hang out where, we're in a place that they think is most important. Okay, question is that I bought 2 close and exited 4 close. Let me take a look at yesterday. Try to keep the questions just related to today. But anyway, he bought the 2 close and the 4 close. Sold the 7 close, seeing the big bear bars. So sold the 7 close, but covered at 12 high. Did not take the 66 short, thinking it will reverse again and missed a huge swing down. Can you advise on trade management, please? Yeah, I think selling the 2 close or the 2 low made sense. A buy climax, possible lower high compared to yesterday's high, and at the 60-minute moving average. So on the open, no matter how strong a move up or down the market makes, 50% of the time it's in the wrong direction. So selling below 2 and below 4 is reasonable. And he also sold the 7 close and covered above here. The reason I would not have sold the 7 close is it's going down too far too fast, and the 2 big bear bars, and too far below the moving average. So I'd sell 2 and I'd sell 3 and 4, and maybe 6. 7, I might sell with a stop below it, but I would not sell the close. And I probably would have gotten out about 10, a second reversal up with 3 bull bars. So I think that's okay. But anyway, he made a lot of money on his shorts. And then he wrote, did not take the 66 short, thinking it was going to be minor. And it probably was going to be minor. But, okay, here, this is what I talk about all the time. A lot of trading range trading. But now we have consecutive big bear bars closing near their lows, both of them closing below the moving average, and at least one of them, at least the second one, the body is completely below the moving average. So to me, that's a sell to close trade. And a lot of the best trades happen very, very fast, and you don't have time to think about it. That was an example. It's a Forrest Gump trade. You know you should do it, so you just do it. And if you're afraid, then quickly reduce your position size and do it. You can sell more lower. Similar to this, you don't know if the best buy is about 12 or 13 or 14 or any of those, but you know it's probably going up, so you just buy small and you can add on higher. The same with this. It looks like we're going up. I don't know that we're going to go a lot up. I think we're going to get a wedge, but you can buy and try to get 5 or 10, 15 points, and if you have to, you trade small. Question in the course, you mentioned that break-even stops have no mathematical basis and are stupid. I assume it ignores the trader's equation. Can you elaborate on the math? Should I abandon using break-even stops? I think mathematically, they're stupid. There's no mathematical basis for a break-even stop. Emotionally, they're significant. A lot of times if you have a big reward or you have a reasonable profit, and for example, let's say you're scalping. I talked about this the other day. Let's say you're scalping for 5 points and the market goes up and touches your limit order but does not fill your limit order. If you're quick, you can get out as it reverses down 1 or 2 points and end up with 1, 2, or 3 points profit. But if you're not quick, I would just get out break even. And why is that? Because if you're scalping, you do not believe the market's going to go up all that far. You're betting on reversals. And if it hits a profit taking limit order and did not fill it, you're going to be thinking, and it reverses down, it's probably not going to go back up until it's finished reversing down. And you don't know that it's going to finish reversing down at your original entry price. So, to me, in that kind of a situation, if I was not quick enough to see that it was like a 21 tick trap or a 41 tick trap, if I wasn't quick enough to get out, I will use a break-even stop. I'm usually pretty fast getting out of trades that are not working, so I rarely ever end up using a break-even stop. And then late in the day, final half hour or so, I don't want the market to come back against me. Yet the market often moves very fast, and sometimes it'll move so fast that I don't have time to get out, preserving 1 or 2 or 3 points profit. And so instead, I'll just place a break-even stop, and if it gets hit, that's fine. So it's more emotional than mathematical. So if you're using break-even stops, I wouldn't use them routinely. A lot of times, I'll use stops that end up being about break-even. So let's say I bought the 12 close, and I think I did buy right after the 12 close, and then I see 13. It should keep going up, and if this is good, it's not going to come back down to the 13 low, and it will not come more than a point or so below the 12 high. So in a situation like that, I will use around a break-even stop. So when you look at something and you're confident you should get a second leg, and instead it immediately reverses and does something it should not do, I will get out early. So instead of putting a stop, if I buy the 12 high and it goes up to 13, I'll follow through 14, I'll probably place a stop to get out around break even, because this should not come back down there and let other bulls buy. The bulls who bought here are rewarded for the risk taking, and the bulls who are waiting to buy the pullback, they did not take the risk, and probably the market is not going to allow them to buy at the price where you bought. So if it comes down to that price and lets them buy, good fill, bad trade. So whenever the market gives you a fill that you think you should not get, you're probably trading in the wrong direction. So that's basically a break-even stop. So a lot of times I'll use stops that are kind of like break-even, but I may get out a little bit better than break-even, a little bit worse than break-even, and I don't think of it so much as a break-even stop as I think of it more as the market is breaking out strongly, and it should not retrace very much. And if it does, then the breakout has a higher chance of failing, and I no longer want to be in it. All right, you can see where we closed, just a little bit above the midpoint of the day's range. Remember, if the market cannot close on the high, and if it's not going to close on the low, it often gets pulled to the middle of the day's range. and that makes the day more neutral. So traders want to see tomorrow. I think a lot of institutional traders are waiting for the earnings reports, and then they'll start buying or selling. And as I keep saying, I want the market to go below the June low and then reverse up. Because I'm expecting a rally in the second half of the year. I don't know that the rally begins on July 1st and continues up to December 31st, but I think the sell-off was not especially strong. It looks like a bear leg in a trading range. So from here, it looks like we tried to bottom, failed. If we get a second attempt at the bottom, it'll probably succeed. Bear channel, bull flag, we should get a bull breakout. And how far up should we go? Probably up to a major lower high like that or that. I think if we reverse up before going much lower, we'll probably get back up in that area, 45, 47, maybe up to the high of the year. But we'll see. Okay, hope everybody has a good night.